Hi everyone, thank you for joining us today. The slide deck can be found in the handout section of your webinar toolbar. Please use the question section on the right-hand side to ask questions throughout the presentation. We will be holding and answering questions at the end of the presentation. We will also be sharing the slides and the presentation video recording link following the live presentation. Now over to today's presenter, Dan Mayo, our Federal Tax Policy Lead.
Great, thank you, Allison, and it's great to be here today. Thank you everyone for joining on a holiday. And so today we're going to talk about the employee retention credit, and it's a fantastic refund opportunity. We're going to talk about the retroactive election, the credits that can be taken for 2020, and also the prospective credits for 2021. And so let's start with who's here presenting today. And starting with me, my name is, next slide please. So my name is Dan Mayo. I'm the National Lead for Federal Tax Policy here at Withum. I sit in the Whippany office and in New Jersey. Also today here is Jeremiah Ramos, who is a CPA with the firm, and also Matt Walsh, another CPA who is the lead on our SBA Financial Assistance Services team. The three of us have spent a lot of time on the PPP, loan forgiveness calculations, and also the employee retention credit, payroll tax deferral, et cetera. But many of these CARES Act provisions that came in March when the CARES Act was passed. So the next slide, we'll talk about the agenda, and we're going to focus today on sort of what's new with the ERC. Next slide, please. Great. What's new with the ERCs, the employee retention credit. So we'll talk about what's new, what changed, who can claim it, what limitations are there, how do we claim it, and also how does it interact with other credits and the PPP loan forgiveness. And that's a key portion, since that's what's driving a lot of the change for 2020, the retroactivity piece. So what is it? It's the ERC is a fully refundable tax credit for wages paid to employees during certain periods of economic hardship that were defined in the CARES Act. They define those periods of economic hardship, and we'll discuss this in great detail on the later slides, but either a full or partial shutdown that relates to COVID-19, or a more than 50% decline in gross receipts, regardless of the reason. So the rule doesn't inquire why gross receipts declined more than 50%. As long as they did, you meet the test. So the ERC came in on March 27th last year as part of the CARES Act. And what's driving a lot of the interest lately are the changes that happened. And so the ERC was a big deal that happened last year. But there was a lot of people are not familiar with it, because if you received a PPP loan, you were boxed out of claiming the ERC. And the PPP is a paycheck protection program that provides forgivable loans. And for most people, if you were eligible for both, it was more favorable to claim to take a PPP and try and seek full forgiveness from the lender and the SBA. And so appropriately, most people chose to take the PPP loan, which meant they had to give up claiming the employee retention credit. So once they knew that, a lot of people, they stopped paying attention to what the ERC was. But the law changed on December 27th of last year, when Congress passed and the president signed the Consolidated Appropriations Act 2021, and that's the official title of that legislation. And so what they did was they eliminated that ban on to the employee retention credit if a taxpayer also obtained the PPP loan. And so this is what creates this retroactive 2020 refund opportunity, which we're going to focus on part of the time today, and which is really going to result in a huge windfall to a lot of companies and businesses, not just companies, partnerships, individuals that run businesses. The legislation also extended the employee retention credit into the first 2 calendar quarters of this year, and made it more generous and more profitable for companies. So when I say companies, I mean businesses generally. And so that's another thing we're going to focus on, as a prospective piece. So there's a retroactive component to 2020, and there is a prospective component in the first 2 quarters of 21. Also, the legislation expanded access. It raised the cap on 100 to 500 employees. We'll talk about all of that on the later slides. But I also want to mention there are some legislative proposals afoot to further extend the employee retention credit through all of 2021. Now, that's just a proposal at this point. It's not yet current law. But as you think about when we talk about the first 2 quarters of 21 and how generous that credit is, keep in the back of your mind that right now it's an opportunity to claim the credit for 2 quarters of the year. It may become a full year issue in the next few weeks or months. So the next slide, please. And we will sort of do some comparison between the 2020 and 21 employee retention credits. They are different. And so I thought we'd give a high-level overview first, a couple slides of a high-level overview, and then we'll get into the details. There's a lot of material here, and we made these slides very detailed so you have the information. But you'll note that we're going to gloss over many of the items here because, one, you have the detail here, and two, we want to get to questions. And we realize, we've done a lot of these webinars, and people seem to be most interested in the Q&A portion when we can answer specific questions that people present and send in through the chat feature of the GoToWebinar. So please submit your questions, and we're happy to get to them. We're anticipating leaving 15 to 20 minutes at the end of the presentation to cover any questions that come in. So what are the 2 tests? The way to get into the credit for 2020 is either full or partial suspension of operations or that 50% drop in gross receipts. And once you meet that, it continues. That's for the quarter. It continues for the next quarter. And until you reach 80% of what the gross receipts were in 2020, so till the business recovers in a sense. So if you meet 1 quarter, you'll automatically meet the next quarter. Question is, if you meet quarter 2, you'll automatically meet quarter 3, and you need to qualify again for Q4 if you have to test again for Q4. So you'll note here we see FAQs. These are links. So these are links to IRS frequently asked questions. There's I think 60 or 80 FAQs, I forget now. And all these links are active. So if you just click on the link and when you have the slide deck, it will bring you right to it. Or you can hit control. If it doesn't work, control will activate the link. The links are only on the 2020 side because the IRS has not updated these for the new employee retention credit. So the frequently asked questions that are there that we reference here are relate only to the 2020 credit. But most of the things, the general FAQs, will remain the same because that aspect of the credit hasn't changed. We're going to focus today and highlight the areas that changed, and that's where we'll expect to see changes and additions to the frequently asked questions. So on the right side of eligibility, you'll see it's that same test for 21, full or partial suspension. And there's also a quarterly drop in gross receipts test, but it's only 20% in 21 as opposed to 50% last year. And so the way the comparison works, you compare Q1 21 versus Q1 19 or Q2 21 versus Q2 19. There is an election where you can use the previous quarter. So for example, to test the first quarter of this year, you can elect to use Q4 2020 versus Q4 19. I know it's strange that you're using the Q4 2019 reference period when you're using Q1 back. They are trying to keep it to the same quarter, figuring out revenue more likely to be comparable in the same quarter in a prior year. In terms of the wage period, when you can claim the ERC, the relevant wage period, it was March 13th to the end of the year. Last year, again, as we mentioned, it's only the first 2 calendar quarters in 21. The qualified wages, this does remain the same, just over a different time period. So the qualified, but you'll see how it got broadened in 21. So for 2020, it was 10,000 of wages, which includes your qualified health plan expenses per employee for the whole year. In 2021, it's 10,000 per quarter. So you get 10,000 of wages in the first quarter, you can claim a credit on that, and 10,000 of wages in the second quarter, you can claim a credit on that. And we'll see how more generous the credit is. But by expanding this wage base, you're now eligible for just double the amount of credits. We'll see the credit percentage also goes up on the next slide. So if we turn now to the next slide, please. You see the credit amount, it was 50% of that 10,000 of wages for the year in 2020, which meant there was a maximum credit of 5,000 per employee for the entire year. In 21, it's now 70% of qualified wages. So it's a much more generous credit, which means that because we break it down by quarter, you can get if you paid 10,000 in the first quarter, you can get 7,000 of credit. And if you pay 10,000 in the second quarter, you can get an additional 7,000 of credit. So you're looking at a maximum 14,000 of an employee retention credit for the first 2 quarters of 21. So you can see how it's a much more generous credit amount and wage base, which leads to more than almost tripling of the credit in 21 versus 20. In 2020, you could be anyone could have received an advance payment. The way you claim these credits is you reduce your employment tax and income tax withholdings that you would pay in either on a weekly, monthly, or quarterly basis to the IRS. You would reduce them for the anticipated amount of credits. If the amount of credit in any one quarter exceeded those deposits, you could receive an advance payment from the IRS, as we'll see later on Form 7200. They've restricted that with the new the 2021 ERC, only small employers, meaning with 500 or fewer FTEs in 2019. That's a testing period we're going to see a few times come up, and we'll show you how to calculate that FTE, the number of FTEs. But only those smaller, meaning under 500 or less, can request an advance payment after reducing their employment tax deposits. So let's go to the next slide. And this will be the last of the overview slides, and then I'll turn it over to my colleague, Matt. And this one, covered employees. So who's the covered? This is a key determination, covered employee, because this is really what tells you the amount of the credit. We know it's like in 2020, for example, we know it's 5,000 per employee, but which employees? So if you had 100 or fewer average number of FTEs in 2019, and that's that same FTE calc in 2019, which we'll talk about, then the credit covers all employees, meaning every single employee, whether they worked or didn't work. If you're more than 100 people, though, so what they call, virtually saying this is a larger employer, then it only accounts for the wages of employees that are not providing services. So people you're paying not to work, right? Which is not a very common scenario in the business world. So this is like what we affectionately call Netflix employees, right? That you're paying to sit home and watch Netflix. When you get into 21, another much more generous feature, they've increased that number to 500. So if you have 500 or less FTEs in 2019, the credit covers all of your employees, so every single employee, whether they worked or didn't work. If you're over 500, then that limitation applies. It only applies to the wages of employees not providing services. So when we talk about eligibility, there's eligibility, and then there's really who gets the bulk of the credits. And the bulk of the credits are going to go to these smaller employers, meaning 100 or fewer FTEs for 2020, or 500 or fewer in 21. The PPP is another big one. There's also other credits. There's no double dipping with the PPP. So it is available now as a result of that legislative change. If you've got a PPP, you can still get the employee retention credit, but you can't claim both. And so there's rules that prevent double dipping that also applies to 2021 as well. So now I'll turn it over to Matt, slide 8.
Thanks, Dan. Hope everyone's doing well. Can you go to, yeah, perfect, thank you. So first thing we're gonna do is kind of delve in here to the 2020 employee retention credit and talk about the specific eligibility criteria for that. As Dan mentioned on the overview, now we can both receive the PPP and the employee retention tax credit. So this is something that most PPP borrowers had not previously been looking into for their business, and now they really should be. So in order to be eligible for that 2020 credit, you have to pass a 2-part test. And it's an OR test, right? So you would either have to have had a full or partial suspension of your operations, and this is covered by FAQ 30 to 38 on the IRS website. And if you download the slide deck here, you'll be able to link out directly to that. Or you can have a quarterly drop in 2020 gross receipts. And the drop percentage for the 2020 program is 50%. So if you have a drop in any quarter in 2020 by 50% or more as compared to the same quarter in 2019, you would automatically qualify. A couple other points on eligibility before we dive into each of these tests in specifics is that you have to have carried on a trade or business in 2020 in order to be eligible. There's no size limit of companies, meaning that you can be a larger organization. You're just subject to the 100 versus 500 full-time equivalent or full-time employee, threshold that Dan mentioned earlier, and we'll get into a little bit more in detail later. And the other question that we get a lot is, does this include tax-exempt organizations? And the answer is it does. So next, yeah, thank you. So the first thing we want to do is kind of dig into that full or partial suspension ruling, right? So we get a lot of questions on, okay, so I was affected in this capacity. Do I qualify under the full or partial suspension? And there's a 3-part test here. So the full or partial suspension has to have been due to a government order which restricts your operations. The order has to limit commerce, travel, or group meetings. And on top of that, the order has to affect the typical operations in a non-trivial manner, right? This means that essentially that if you were able to continue operations in the same manner that you were doing in person through telework or from a work from home environment, you likely won't qualify under this. The other thing is to mention here is that the aggregation rules apply, and we'll talk about the aggregation rules. In the PPP world, we have the affiliation rules, and in the employee retention credit world, we have the aggregation rules. So we'll talk a little bit more about what those are like. The common examples here that we have are if you had a reduction in seating capacity, reduction in hours of operation, an order which prohibits suppliers from making delivery of critical goods to you, or a partial closure of operations. And these examples are pulled right from those FAQs 30 to 38. Each of them has, in some cases, multiple examples of businesses that would qualify under them, and they address a lot of the questions. So, you know, if you're saying to yourself, do I qualify under full or partial suspension, and you're unsure, one of the first places that you can go is those FAQs to get there. Some examples that don't meet the test. So if you had a partial closure of your business, but you, like I said earlier, you ran, effectively comparable through telework, then that would not qualify you under this test. And if the business is able to operate, but your sales were down because of a loss of business or customers, that wouldn't necessarily qualify you under the full or partial suspension test. But again, remember that the test for eligibility under the 2020 program is an either or. You can either meet this criteria, the full or partial suspension, or you can meet the reduction in gross receipts. Can we go to the next slide, please? So what does it mean to have declining gross receipts? And again, there's a lot of words on these slides, right? As Dan mentioned earlier, we gave you everything so that you have the detail and can look at it later. But we're going to hit on the higher level here and get to your questions in the FAQ section. The quarterly drop in receipts has to be more than 50%, right? So if you take your 2020 period and you compare it against your 2019 period, you have to have a 50% or greater. One thing about the program is that if you qualify in one quarter, right, you qualify until and through the quarter at which you rise back to above 80% drop, right? So basically, if you qualify in the second quarter, you automatically qualify in the third quarter, even if your third quarter sales in 2020 as compared to 2019 are back up to 90%, because you qualify through the quarter in which you are back up above 80%. So if a fact pattern exists that you were down 50, you were down more than 50% in quarter two, you were down, 25% in quarter three, and then you were down maybe 10% in quarter four, you would qualify through quarter two, quarter three, and quarter four. We get a lot of questions on gross receipts. For those of you going through the PPP2 process, you know that the gross receipts is a big question as well. There's some detail in here, but generally a gross receipts includes everything. It's not reduced by cost of goods sold, and it doesn't include anything like the repayment of loans or amounts received for sales tax that you then remit to a governmental agency. We also get a lot of questions on gross receipts for tax exempts. There's no specific guidance here, but there is a regulation that we've studied here that includes just a broad definition of gross receipts, and it does include things like grants, contributions, amounts from dues and assessments and other gross receipts. You should just retain your proof of the decline in gross receipts for at least 4 years in the event that the credit is audited. And I mentioned earlier the aggregation rules. So there are aggregation rules under the IRS that must be followed here. This is when you consider parent and sub situations. It considers brother and sister corporations. Generally speaking, it follows like a 50% test. So if you have 50% of the vote or value for a parent sub aggregation, that means you're going to have to aggregate to test your gross receipts and to test whether or not you have a full or partial suspension of business operations. And then the employee retention credit would just be apportioned among the group members. So with that being said, I'm going to pass it over, Jeremiah. Do you want to pick up and talk a little bit about qualified wages here?
Yep. So thanks, Matt. So for qualified wages, we're only going to include those amounts paid between March 13, 2020 through the end of the year, so December 31st, 2020. It includes up to $10,000 in wages and qualified health plan expenses per employee. So you could have a situation where you have 20 employees it's not going to be the total cap on all your wages. It's going to be at an individual employee by individual employee basis. There's no dollar limit or cap on qualified wages as with the PPP. The one exception to that rule is if you have shareholders, partners, owners that own more than 50% of the business and also have qualifying relatives within that business. So an example would be if you have a family-owned business that has nieces, nephews, uncles, brothers, sibling-in-laws, all working within the business, and they own more than 50%, those wages will not qualify. But for the most part, you're going to see wages to employees up to $10,000 qualifying for this credit. It excludes severance paid to former employees after they were terminated. It also excludes a certain income that would be exempt from Social Security and Medicare taxes, like payments made to independent contractors or church employees. And then also there's two different definitions when it comes to qualified wages for a partial suspension or a decline in gross receipts. For a full suspension, if you had a suspension, let's say for 2 weeks, you were a bar or restaurant and you were shut down for 2 weeks, if you meet the criteria for that specific time period, you could only include the wages for those 2-week period. That's why the decline in gross receipts is really the best way to qualify. Just because you qualify for the entire period, and like Matt mentioned before, you automatically qualify for the next quarter. So you could have 2 quarters of wages versus a partial suspension only gets you 2, maybe 3 weeks of wages paid to qualify for that credit. Also continue with qualified wages. It also includes the health plan expenses. So these will be the proportionate share of health insurance paid on behalf of the employee. Also includes certain expenses to maintain those accounts. So for example, if you have a situation where the employee is not working, they were furloughed, but you're still maintaining those health insurance plans, those will still qualify for those costs when it comes to those employees. But remember, you can't double dip. So there's a lot of interplay between the PPP, the qualified sick and family leave, where those wages will be used for forgiveness. Those wages will be used for additional credits. A good example would be the R&D credit. If you're using those credits, you can't double dip. So you can't use amounts from a PPP loan, pay wages, and then also claim a credit on that amount. So this is what makes calculating an ERC, especially retroactively, more complicated, because you have to do that additional math of figuring out how do I want to maximize my PPP forgiveness and how do I want to maximize this ERC credit. It is important to note that, of course, PPP forgiveness is going to be your top priority because it is a dollar-to-dollar forgiveness versus this credit is a 50% credit. So of course you want to take the 100% over the 50%, but you still want to maximize both of them so you get the optimal credit. There are some limitations on qualified wages, as Dan mentioned before, with the rule of 100 or more FTEs. For this FTE calc, it's going to be on a different basis than the PPP. So if you're familiar with the 40 hours or more full-time equivalent, for this one, it's going to be just the 30 hours for that specific employee. So it looks more towards the Obamacare rules, the Affordable Care Act, when calculating those FTEs. There's also a limitation on a look-back rule for periods of economic hardship. So if you have bonuses paid to employees during those time periods, the 30-day look-back, those wages will not qualify. But for the most part, I have not seen this being an issue because assuming if you pay bonuses to employees, they're probably highly compensated. They're probably already over the $10,000 threshold. But just when calculating wages paid to a particular quarter, you want to make sure to back those wages out. And for the most part, a lot of payroll providers will include reports showing those bonuses, so you can easily back those out when you're doing the calculation. For 100 or fewer average FTEs in 2019, you can include all the wages for all employees. For over 100, there is that rule when it comes to employees that are not working. and paying those wages. Remember, you can only include the wages for those employees that were not working. So for example, if you had a chain of gyms, you had more than 100 employees, you were closed for a month, but out of the kindness of your own heart, you paid all those employees to work and stay at home and watch Netflix and whatnot and get the full benefit of their paycheck. We probably won't see that for the most part, especially those employees who probably weren't working, where a lot of businesses were using PPP funds to pay those employees. And lastly, self-employed individuals do not qualify. So if you have an individual with a Schedule C and they're asking if they're eligible to take this credit, unfortunately, they are not. And like I mentioned before, the FTE calculation, it's going to be an average when it comes to the 2019 FTEs, and it's going to be based on the 30 hours, not the 40 hours. So it means that if an employee worked at least 30 hours a week or 130 hours a month, they're going to be considered one FTE. If you have a situation where you have a part-time employee, let's say they work 15 hours a week, their FTE is going to be half of that's going to be a 0.5. So two employees that work 15 hours a week is going to be one FTE versus one employee that works more than 30 hours a week is going to be one employee. And this matters just because you could have instances where you have over 100 employees on the face of it, but when you actually dive into it, you see 20 of them might be independent contractors, another 30 of them might be part-time employees, and then when you're actually calculating the FTE, it comes out you maybe have 90 employees and you qualify for the entire credit. That's why that 100 FTE threshold is so important, because once you have one more than 100, then it kind of disqualifies you for a large portion of the credit. So how is the 2020 ERC calculated? The credit amount is 50% of qualified wages. So it's going to be $5,000 per employee. So remember, it's your qualified wages up to 10,000. Half of that's 5,000. So you could have instances where you have 90 employees, multiply that by $5,000, and that's a considerable credit. So when we're looking back for clients that we've done the calculation already, we found that 20, 30 employees will get you a considerable amount of credit if you qualify for those specific quarters. But remember, there is an interaction with the PPP, qualified sick family leave credits, work opportunity credits. All of these can be found in the 941. So if you're reviewing your 941, you're seeing you're taking credits from prior quarters, you do have to account for that when you're calculating qualified wages. But the good thing about this is that for PPP forgiveness, there is excess wages, especially when you're looking over the 24-week period, where you have especially highly compensated individuals where they're already capped for PPP, they have excess wages, and those wages can be used for the ERC. So how do you claim the 2020 ERC? So if you were claiming it previously, you just filed your 941s, but since we are past that, this is a retroactive change, you have to file those amended 941s. So that's going to be your 941X. There was an option to take advances on those payments, Form 7200, but unfortunately, those will only be available for 2021 and beyond. You can't take a retroactive credit using that form. You actually have to amend, go back, especially for the first quarter is going to be reported on Q2, and then Q3 and Q4. So if you qualify for all 4 quarters, you just have to amend those 3 returns. And for the most part, the credit is calculated pretty simply. The hardest part is just figuring out those qualified wages, the interplay between the PPP and other provisions, figuring out what that number is. You provide that number to your whoever is preparing your 941s, either in-house or through a payroll provider. It's one line on the return. You take 50% of that, and that's going to be your credit. So our suggested approach when it comes to maximizing your ERC, but also your PPP loan forgiveness, is to go through those wages for those highly compensated individuals. Remember, PPP is limited to $100,000, but there's no limitations to ERC. So odds are, if those employees are capped at $100,000, you're not reporting the full amount of their wages on that PPP forgiveness. So there's going to be a cushion there where you can take those wages, especially if you can afford to take $10,000 away from the PPP and use that for the ERC. Then what you want to do is you want to go through and subsequently see what the lower paid employees are at, and see if you can reach back into the PPP and carve out some of those wages. So you want to look at your PPP and say, how much wages can I afford to give up? You take those total wages and then you go back to those individuals and then you try to reach each person to 10,000. So in a lot of instances, you won't need to get a significant amount of wages back. So you could have an individual, they might have $9,000 of qualified wages. You only need $1,000 more for them to get them to the 10,000. Then you go to the next employee, maybe they need $2,000 in wages. You do the same process again, you reach back and you pull those wages. So for mergers and acquisitions, if you did acquire a business in 2020, there could be an issue, especially if you don't have the wages to report in 2019. So for example, if you significantly increase the gross receipts of your business because you purchased several other subsidiaries and those gross receipts are going to be included in your 2020 income, it's going to distort your numbers in a way that it's not going to qualify you when you're comparing it to 2019. But there is a safe harbor where if the information is available, you can include those gross receipts as if they were 2019, even if you didn't own those specific entities. What about acquisitions in Q4 of 2019? There won't be an impact on the 2020 ERC because gross receipts included in both Q4 2020 and 2019. For 2021 ERC, recall companies is Q1 2021 to Q1 2019. So you will, instead of looking at 2020, you could go all the way back to Q1 of 2019. And then finally, for the taxation of the ERC, the amounts similar to PPP before the change, before that it was both non-taxable and tax deductible. It is not included in taxable income, but it will be considered an offset of your payroll taxes. So this would be a good example would be R&D credits, where if you get the credits on your 941s, it's going to reduce those wages. It's going to be an M1 on your federal tax return, and you will not get the benefit of that. So in a sense, it is taxable, but the difference is just the way it's reported. And then with that,
Great,
I'll kick it back to Dan.
Yeah, thank you. So we're going to talk now about, thank you, Jeremiah, for that. And Matt, we're wrapping up 2020 ERC, and it's a great refund opportunity, particularly to the businesses whose 2019 FTE count is 100 or less. For 2021, go to the next slide, we'll see that the tests are similar but different. The full or partial suspension of operations still applies, so when those rules that Matt went through still do apply. But the quarterly drop is now 20% compared to 2019. It's not a 50% drop. I know we talked about this earlier, so I won't dwell on it. There is that election you can use for the prior quarter. So if that's helpful, you can use the fourth quarter instead of Q1. We expect they'll come out with guidance on how to administer the election and how to take advantage of it in the new FAQs when the IRS comes out with them. They did state publicly at a conference that guidance in the form probably of new FAQs will be coming out soon. They didn't say how soon. I think it was like a line from a movie when they said soon, and the question was how soon. They said very soon. So that's the best you can get out of the IRS. There is no size limit, as with the 2020. It applies to large and small employers, but the credit amount will differ. So the next slide. Here we talk about the differences. Remember, somewhat restating the rules, but we add a little bit. 2020, those two tests there. In 21, same full or partial suspension. It's a 50% is now 20% reduction in gross receipts. And they expanded it to include certain public instrumentalities like hospitals, universities, medical care providers. And also it includes employers who are not in existence in 2019. So that's a positive development for newer businesses. On the next slide, we're going to talk about qualified wages. We talked about it's only the first 2 calendar quarters of this year so far. That may change in the future, but right now it's only 2 calendar quarters. There's no dollar limit or cap on qualified wages like there is in the PPP. And so it also includes up to $10,000 per quarter, which includes qualified health plan expenses. So it is, $10,000 in the first quarter, $10,000 in the second quarter. Unfortunately, if you have $11,000 in the first quarter and $9,000 in the second quarter, you can't average them. So you would get 70% of $10,000 and 70% of $9,000. You wouldn't be able to fully maximize the credit, which suggests you might want to consider, bunching wages if it comes to it at quarter end. On the full or partial suspension tests, same as with 2020, it only applies to wages during the period of suspension and not the whole quarter, whereas a decline in gross receipts test gives you the whole quarter. But unlike 2020, it's each quarter is tested independently. There's no that you don't have that rule where you return to 80%, given that they're using a 20% test to begin with. On the next slide, we'll talk about the relaxed limitation on qualified wages. This is again one of these very key changes to the way it's calculated. This 100 the 100 limit went to 500, so that if you have more than 500 FTEs in 2019, you're limited to the wages for employees who are not providing services. But if you're 500 or less, it's the wages of every single employee, regardless of whether they work or don't work. So with that, I'll turn it back to Jeremiah to take us to the end, and then we'll get to all the questions.
All right, so we'll look at how the 2021 ERC is calculated. And like Dan mentioned, there are some differences when it comes to eligibility. So you might have not seen clients or businesses eligible in 2020 just because the 50% drop is pretty considerable. If you had $10 million in gross receipts, you would have to have less than $5 million. So for 2021, it's going to just be that 20% drop, plus the increase of the number of employees is going to be up to 500. So you can see much more businesses be able to apply for this credit. And if you just look at the credit in a different way, if you think of it instead of a credit of 70% of wages up to $7,000 per employee, think of it as the government is going to pay 70% of your wages for that specific quarter on employees that make up to $10,000. So we could see, especially with businesses who have more than 300, 400, up to 500 employees, we're talking about millions of dollars in wages that this could potentially be way more than what these businesses would receive in PPP2. So just going back, of course, it's going to be the same interplay between the PPP, qualified sick leave, family leave credits. That is not going to change compared to the 2020 versus 2021. And of course, businesses are going to have to look at what the loan forgiveness is, especially for PPP2, and try to maximize those wages as well. There is talks, especially now with the new stimulus package out, that they could expand this and push it out to the end of 2021. It's not clear if they're going to do $7,000 per quarter for all 4 quarters, or if they're just going to push the eligibility to a maximum of $14,000 per year, but you have those 4 quarters. Either way, it's going to be a considerable credit, especially if it's $7,000 per employee per quarter. That is $28,000 in free wages, in a sense, paid to each employee for the year. And so claiming the credit is going to be a little different than 2020. You do have more options. So instead of having to go back and amending returns and having to wait for those refunds, those who believe they're going to qualify for those ERCs in the first quarter and the second quarter of 2021, what they can do is, if they have fewer than 500 FTEs, they can request advance payments, or they can reduce their deposits. So this would be a considerable amount of money, especially if you're eligible for that $7,000 credit per employee, where you can either request the money up front, or you could just reduce your deposit so that you're not making as large deposits, so that you're trued up by the end of the quarter. And the difficult part about this is just calculating those qualified wages. But once you lock in those qualified wages, you know exactly, especially if you're going through it in real time of delegating, these wages are going to be for PPP, these wages are going to be for sick leave, I'm using these for R&D credits, and then finally have these carved out for the wages I'm paying on a weekly basis for the ERC. You can report that to your payroll provider, and they should be able to reduce those amounts for those credits. So by the end of the quarter, you're trued up, you have the exact amount. You're not double dipping in any way when it comes to R&D, family leave, and of course the PPP loan. So we put together a sample document request list that we have been sending our clients. This is going to be quite extensive. We put it on here just to give you all the information that you could possibly have. But for the most part, the information is going to be a lot smaller that we require when it comes to the clients, whether it just be payroll journals or prior 941s to figure out the information. But for this document request list, just take it as this is the complete list of information you could possibly need in order to take the credit. So the first is you just want to confirm the entity type, especially if it is a S Corp 100% owned. You want to make sure those wages for that owner are not going to be included. You also want to obtain those 941s that were filed in 2020 and 2021. So the main reason for this is they may be taking credits that they're unaware of. They could be taking sick leave credits. They could be taking R&D credits. And the best way to figure that out is just looking at the 941s, seeing if those credits are being taken, and then getting the backup for the wages used for those amounts. You also want to confirm whether there are any greater than 50% owners. And then if there are, you want to make sure that those individuals that are related to those owners are not going to be included. Also, if there's any subsidiaries, so if you have a large corporation, they have multiple subsidiaries, those will have to be aggregated for the FTE purposes. For individual filing, you could have each subsidiary filing their own 941s. Those will have to be done separately. But just to calculate the FTEs, the gross receipts test, those will have to be all aggregated as one entity. You calculate what the amounts will be, and then you break everything up, and everyone goes on their way, claiming the credit at the individual levels. Some more information we request is to see if they're eligible, if they meet certain requirements. For the most part, you're going to ask for those gross receipts. You're going to ask for the average number of FTEs. You're going to see if there's any subsidiaries for the aggregation rules. You're just going to ask different questions just to probe them and see if they're eligible. For the most part, it's going to be that gross receipts test. You can just compare the Q1 through Q4 of 2019 compared to 2020 and 2021 to see if they're eligible. If not, you can ask if there's any closures, especially if you have clients or if you're a business owner who's in a bar or restaurant. There are gyms, there are different industries that were significantly impacted and they were closed down. For many businesses, especially in New York City, you had extended closures and partial closures pretty much for the entire year. So in those instances, you really want to get that information, because if they don't qualify for the gross receipts test, then they would definitely qualify for those closure periods. For 2020 ERC, you also want to get the payroll reports from 3/13/2020 to 12/31/2020. This is definitely needed on a paycheck by paycheck basis. It's difficult to see, especially when you have interplays between PPP and other credits. You just want to make sure that you have all of those checks separated by each specific period. Because remember, if you have a closure, you can only take those checks, those pay periods between certain times. If you have quarterly tests, it's only going to be those wages paid to those quarters. So it's important to get a more detailed payroll journal instead of just the summary for an entire year, because you can't really tell if someone was paid $40,000, whether it was paid mostly in the beginning of the year, at the end of the year, how much PPP was used against those wages. That's why it's so important just to get that detailed journal. For 2021, it's going to be similar, but just 1/1/2021 through 6/30/2021. Of course, you know, it's only 2/15 right now, so you're probably not going to have those payroll journals through 6/30. But for estimate purposes, you can project out, you can see these are how many employees that I have right now. this is my projected pay over the next couple of weeks, and you can see what those credits are going to be, especially if you're going to take those advances up front, or if you want to reduce the amount of payroll taxes that you're paying in with your deposits, whether on a weekly basis or a bi-weekly basis. You also want to get documents related to PPP-1 and PPP-2. This is just to make sure that there's no overlap. You want to make sure that if they have any spread on that PPP loan that you can take, let's say, for example, they have excess wages of $100,000 that they're not using, you can allocate those wages in a more productive way, especially to claim that ERC for 2021. You want to make sure that you have the right disbursement dates, copies of the loan forgiveness, whether or not that there was a forgiveness allowed. You could have instances where PPP forgiveness was not allowed, it was disqualified, and therefore all of the wages would be eligible for the ERC. And of course, if you need any more information, there's a ton of information on the IRS website with the FAQs. We put all the links in here, so all you have to do is just, click on the links, find out more information, and of course, you could always reach out to our team here at Withum.
All right. Thanks, Jeremiah. So we have quite a few questions in here, and I'm going to try to group a lot of them together. So, just so we can get through them all, we have about 15 minutes, so we'll jump right in. Dan and Jeremiah, there's a lot of questions in here about shareholder and family member wages. We've got a couple situations where you have a husband and wife, where the wife owns 51%, husband owns 49%. A few situations in here where S corporations, 100% shareholder employs family members, cousins, kids. Can we talk just a little bit about what the family member rules are for purposes of the ERC?
Yeah, sure, I can take that. I'll start with that one. Please chime in too, Jeremiah. So FAQ 59, this is the key question here. We're laid out the rules. And FAQ 59 talks about if it's a shareholder or partner, have to have more than 50% of the stock in the company or capital interest in the partnership. Then it also applies to children and the listed relative. It applies to listed relatives of those shareholders. So it is a somewhat broad rule, but it does apply only to the people that are listed there. I think this is on slide. Let me see, slide 12, where they list again. There's a link to that FAQ 59, which includes the information.
And then I would also add that there could be instances where you could have an employee that's also a spouse, and you would have to attribute that ownership to that individual. So you could have a 50-50 owned husband and wife, and you say to yourself, all right, it's only owned 50-50, we're not over 50%, so the wages should qualify. In those instances, there's an effective ownership of 100% since it's owned by husband and spouse. So you wouldn't be able to include those wages.
Right. Okay, thank you. So we have a question here that says, how soon after a business exhausts its PPP can it qualify for the ERC? Does it, if it uses all the PPP mid-quarter, can it use the rest of the quarter, or how would we go about sort of like allocating between those two?
Yes, I think the first you have to determine how you're entitled to the credit. So if you're entitled to the credit under the full or partial suspension test, you're limited to the period of the suspension. If you're using the drop in gross receipts test, you get the whole quarter and the next quarter. Once you're there, then you look at the wages, and we expect there to be additional guidance from the IRS on how to do the allocation. As of now, they issued a press release, I think a couple weeks ago. I think it's actually in the slides at the back. There's a link to it. And that release says that you can allocate any wages to either program if it's eligible. So suggesting you have extreme flexibility on how to allocate the wages. And we've been doing the calculations under a flexible approach to maximize both opportunities.
Right. And just to add to that from the PPP side, there's also flexibility within that program, as we've seen the updated application for loan forgiveness, which just indicates that you, if you're filing on a go-forward basis, not to include any wages that were used to calculate an ERC.
Yeah, one of the key things is too, so we know, like, if you had $1 million PPP loan, for example, it would be routine for someone to have $1.5 million to $2 million of payroll on the PPP loan forgiveness application. Now, just because you list 2 million, let's say, of payroll, doesn't mean that full 2 million is excluded from the ERC calculation. We know that you only needed $1 million to get full forgiveness. And so the question is, which million do you take? And that's where you get into the flexible allocation. You need to make sure that you've allocated enough of the million to PPP because you got forgiveness based on that. But the excess can be used, and that's sort of the art to this. You know, not a science, it's an art to allocating the wages in the most favorable manner.
Mhm. And I would just add one more thing to that, that the way that the legislation was written, it takes the ERC first and allocates those wages. And then there is an election to ignore and not treat those specific wages for that employees for the ERC. So I think the best way to do it is to pretty much take as much at the ERC that you possibly can until you reach a point where you're not able to reach full forgiveness. And then any of those excess wages you just push into the PPP. Because of course you want the 100% versus the 50-50 or 70, 100%.
Right. Okay, thanks. So, you know, Dan, you had alluded to this, you know, and we talked a little bit about the differences between the affiliation and aggregation. Can we just touch again upon what are the requirements when you have entities that meet the definition to be aggregated? Do you have to meet the 50% requirement over both of those entities or all of those entities?
Yeah, so this is this could be its own you know, hour-long class on the aggregation rules. Same with the affiliation rules under the PPP.
Right.
Matt and I have certainly dealt with them endlessly for clients. But so I put in the slide deck, like, generally use a 50% voter value test for parent sub, and I think that's going to resolve most questions for most people, right? There are complicated rules that look at it, like section 414 and 52. It's in those that FAQ 43, by the way, list all the rules. But for you have a 100% owned sub, that's going to be aggregated, right? And I think that's going to resolve probably at least half. The rule of 50% voter value will resolve another 45 to 49%. And the complicated cases come when it's you know, you have partnerships or estates, trusts, and where it's not that high level of ownership.
Right.
But the aggregation rules, once you conclude you aggregate, you have to aggregate for purposes of various tests, including the gross receipts test and the number of employees.
Right. Okay. So one question we got in here is surrounding if you qualify for the 2020 program, not under the gross receipts reduction, but under the partial suspension. When you qualify for a partial or full suspension of activities, do you automatically qualify for the full quarter? Is there a certain portion of time? What does that cover?
Yeah, so for that one, it's going to be just that period of closure. So if you were partially closed, let's say, for example, you're only allowed 50% in your restaurant or business, and it significantly impacted your business, it's only to the period when that was first put into place and then when it was lifted. So if that's a 3-month period, it's going to be a 3-month period, even if it overlapped 2 quarters. So you're still going to have to amend those 2 quarters, but it's only going to include those pay dates, those pay periods between the closure and the lifting of that closure.
Right. And is there anything that precludes you from qualifying under both? Like one of the questions here brings up an example that we have like a restaurant who was mandatorily closed down for you know, for the second quarter, but may not have hit the 50% reduction, but then in the third quarter hit the 50% reduction. Can they qualify, you know, for the second quarter under the partial suspension of operations or full suspension, and then the third quarter under the receipts?
Yeah, so in that instance, they should be able to take, of course, the more beneficial one is for the full quarter because you get not only the quarter that you qualify, but also the subsequent quarter. But if you do have a closure, for example, let's say in Q1 and Q2 you qualify, but Q3 you don't qualify anymore due to the gross receipts test, but you still have that partial closure, you can take those dates within that quarter and apply that. So you could always go back and forth, see which one is more beneficial and to maximize that credit.
Right. Okay. So we're getting a lot of questions, not a lot, a couple of questions in here that talk about eligible wages and eligible expenses towards the $10,000 max. Does that, and I think some of these questions are sort of on the back of the PPP where those healthcare costs and other payroll costs are added on top of the cap, right? Does the 10,000 include all wages and healthcare costs per person?
Yeah, 10,000 includes everything. It is unlike the PPP where the payroll cost was the cash compensation plus those other items, the retirement, the health, and the state and local taxes. Here it's 10,000 including the wages and the health plan expenses.
Right. And the wages includes bonuses and includes, you know, like any other pay that would generally be included in gross wages.
Yes and no. There is that special rule we listed about you have to look at the immediate 30 days, but that depends on the size, right? You have more than 100 FTEs in 2019. There's a 30-day look back rule, so that would limit your ability to pay bonuses, that kind of thing.
Right. Right.
But again,
Okay,
in
so,
order to get, if you qualify for the quarter, you need 10,000 of wages, including health plan expenses. So you're looking at an employee making 40,000 for the year. Anyone making over 40, you're clearly going to qualify. Under 40, you probably will too with the health plan expenses.
right. Yep. Okay, so there's a lot of questions in here about a 941X, and I think Jeremiah, you talked about this. Is there any information out here that we may see an adjustment to that instead of needing to go back and file 3 amended returns for 2020 that that they streamline the process?
Yeah, so it's funny because the IRS came out last minute, I think a week before the 941s were due for the fourth quarter, and said if you didn't get full loan forgiveness or if loan forgiveness was denied, that you could take the full retroactive credit in the fourth quarter. But for some reason, they didn't give the option to other individuals or other businesses that would qualify. They would have to go back and unfortunately amend those returns. We're still waiting for guidance, so there might be hopefully some retroactive changes, possibly in Q1, maybe you could go all the way back and take the credits. But as of now, the only thing we know is that most likely you will have to amend those prior returns to claim those credits for those specific quarters.
And 2 key points of that too. If you use a PEO, they will amend it for you. So you're literally giving them one number for each quarter, and then they're going to go back and file 3 amended returns for you at 941Xs. The other point is, and I don't know how accurate this is, but at least one of the large PEOs has been reporting it can take up to 6 months to get the refund. So I don't know that the IRS is that backlogged. I would have thought it was closer to 2 months, but they're predicting 6 months.
Right. And what's the limitation? Is there a current limitation on when you can file the 941Xs?
I'm not too sure if there's a statute of limitation, but especially if it's a large amount of money, you definitely want to file as soon as possible.
Right.
Yeah, it's the regular statute of limitations, whatever that is. I don't know offhand, but certainly you'll have at least a year, but you shouldn't be waiting beyond that long, especially since you need to file estimated taxes. And so you're going to want to know, your ultimate payroll tax obligation. It's going to be helpful to know to file estimated annual tax returns.
Yeah, we do only have a couple more minutes, so we'll get in as many questions, but that dovetails into one of the questions here for you both is what happens, given that you have to reduce the wages on the tax return, what happens if you don't know your employee retention credit amount for 2020? How would you treat that? Do you reduce in a future tax year, or?
You go back and amend. You'd have to go back and amend the 2020 return. It wouldn't be a future year adjustment. It would just be an amendment to the prior year, which is why it behooves people to complete this now, get it in for their estimated tax payments, and then put it on the final, the extended return for 20 and be done with it.
Right.
There's absolutely no point in waiting, given it's a cash benefit to the business.
Right. Yep. I think we have time for one more question, and we have a question here that says we have employees who earn wages in multiple companies. Can you take a credit of up to $10,000 in each of the companies that they earn wages for?
Not if they're a qualified employer. I'm sorry, if they're an aggregated employer. If they're aggregated, you're treated as a single employer, which means you're capped out at the 10,000 per employee.
Okay. Actually, we do have time for one more question, and it's the last question I got in here is how does the deferred payroll tax credits that were issued as part of the FFCRA, I think, right before the CARES Act, how does that impact your employee retention credit?
Short answer is it doesn't. You can do both. You can take the payroll deferral, which was CARES Act too, by the way. That was
it was
also
the
part of the
CARES
CARES Act, yeah. And you can take that and you can layer on the employee retention credit. The only thing we're highlighting to people, and which is important, if they want to take the deduction in 2020, they need to pay it by August 15th, or no, 8.5 months. So yeah, August 15th.
Right. All right, perfect. Well, that wraps us up. It is 12:30. We thank everybody for joining us today. We'll have the deck and the information available for all of you. If you have further questions, we always invite you to reach out to your Withum advisor. And we thank you for joining us. Hope everyone has a great day.
Everyone.